going to say, even in the world of commodity money, say the gold standard, the fact is, the vast majority of transactions were not actually transacted in gold. Not least because they're gold would often be very, very scarce, because most people would be hoarding it. So you still had, even under the gold standard and its precursors like silver standard and other representatives, you still had basically most business was conducted on credit.
Yeah.
And credit was, the actual note. You had banks issued their own notes. Now, in theory, they were redeemable in specie, which is gold or whatever, base money you officially had. But as often as not, the credit creation process meant that you had far more paper money in circulation than the actual base money. And of course, what happens when confidence drains? Everyone tries to redeem their paper money for the base money, the gold. And of course, that's when you have major collapses and depressions as money just drains out the system. Nobody has any faith in the paper money, and the real gold money becomes so valuable, everybody hoards it. So therefore, you've got no transacting material, and therefore you get a depression. I mean, this is also one of the fallacies that people have about the gold standard, is there's no inflation in a gold standard system, which is completely not true. I mean, because you get inflation based on the credit creation process.
Yeah.
What you did have in the gold standard system was you'd have bouts of massive inflation, say during wars or times when credit was easy, and then you'd have an almighty bust that would, the economy would deflate, trying to fit back to the base money available, which of course had massively deflationary impacts. And it's probably the source of a lot of the latter, the revolutions of the latter 18th century and 19th century were often as much as not credit collapses.
Yeah. No, I think that's a very good summary, PHS. But one thing I'd say is that when you talk about credit creation during wars, etc., I mean, part of the problem with the gold standard is that ultimately you are privileging monetary stability over economic stability with the gold standard. And when it came to the crunch, like during a war, democratic governments would suspend the gold standard because they needed to be able to print money. So that's exactly what Britain did in the First World War. In fact, all the major powers essentially suspended the gold standard during the First World War.
Yeah, they had to, because I mean, war is the ultimate between countries. It's the ultimate test, and you're not going to say, well, we run out of gold, therefore we're going to stop fighting.
Exactly.
You do whatever it takes. I mean, we did the same thing during the Napoleonic War. I mean, there's the British government issued huge amounts of debt, but people were confident in it because, in theory, with all the gold that they had available from our trade with the rest of the world at a time when much of Europe got cut off by the Royal Navy. So people knew that the government, but equally, when the war came to an end and people started to redeem that paper issued during wartime paper for gold, you had an almighty credit contraction after the Napoleonic Wars, that led to the Luddite rebellions and the Peterloo massacre, and the general collapse in trade that happened after the Napoleonic Wars, and the Cato Street conspiracy, and all of those sort of things, revolutionary activity, because people were being thrown out of work, and people didn't like that,
Well,
so
that's great. I mean, do you mind if I include this when I do the video, PHS. What your explanation there?
Yeah,
Thanks.
well, sure. I mean, I'm just you know, throwing out little bits here and there in terms of you know, the sorts of historical events that surrounded whenever you did have a credit creation collapse. But yeah, no, sure, you're happy
So,
to.
well, I will. I'll snip this bit in later because we come to that, and I kind of started to. You see, there's basic concepts that I think I've got down, but then when I try to pull it all together to a final kind of understanding, that's where I'm kind of struggling a bit. And maybe we can resolve it amongst ourselves later. As like I say, I kind of started to almost get there,
You know
but
where this is
we'll
going to
see.
lead, though. You know where this is
Bitcoin?
going to lead. The next, no, not Bitcoin. The real euro dollar.
Yes.
The euro dollar system will be the next logical. Because yeah, I mean that's the next mind-bending trip.
So when
Once
the
you've
that
got the
means
basics.
when the euro when the dollar collapses. Do you
Well,
mean?
maybe. I mean, you could say actually, in a way, the same thing as the gold standard exists today, not within countries, but between countries. But instead
Yes.
of, because the dollar being the transacting medium and the base money for the euro dollar system, which is basically the international monetary system, while it's not fixed in the sense that gold is, the supply of the base money system is controlled by one country, namely the US.
Yeah.
And while credit creation, banks can do their thing of creating money out of thin air, ultimately all of that is tied back theoretically to redeemable in US dollars. And we're going through, and indeed arguably part of the you know, the post 2008 system is the lack of dollar liquidity in the world market, notwithstanding the fact of all the dollar printing that's been going on. There's still a big shortage of dollars, which has interrupted world trade.
Right. So yeah. So I mean, you've said it, but just to summarize what you said, the world is clamoring for dollars, and then that
Yep.
creates a problem because the US can't print too many dollars without causing their own problems.
Yep.
But at the other side of the coin, all the other countries want them to print dollars. Actually,
Yes.
also with when the gold standard collapsed, the UK, I've got that here actually, in 1902, which was when the empire was at its height. 60% of all currencies, foreign exchange reserves were in pound sterling.
Yeah.
So the same as we had World War II to get us to where we are now, which you see here on the left, like you call it the euro dollar. Presumably, we'll have World War III before the next thing takes over. So a
I
sobering,
certainly hope not.
well,
Quite.
a sobering start. So
Mm.
what I'll do is I think we should crack on.
Yeah.
And so thanks a lot, PHS, for being here at the start. And hi, Keith. Good to see you again. And thanks
Right.
for letting me host this on your Discord channel.
You're very welcome. Thanks for doing the work. Now, I should say actually that in the coming weekly, I've got a long section on why the gold standard, resurrecting the gold standard would be a really bad idea. So, you know.
Great. Well,
you can watch that on Friday.
So I've got, yeah, so I'll look forward to seeing that, and maybe we even get a few sneak previews during here. So, okay, so let's briefly do general updates first.
Yep.
Like, not much has changed for me apart from a few bombs going off. Has anything much changed from when we last spoke of your portfolio, Keith?
Well, so what do you mean by a few bombs going off?
Uranium,
Oh, right. Okay.
India,
Well,
and
yeah.
oil on my
Oil's the
in
big
my
one. Yeah.
portfolio.
Yeah. Oil's, I mean, the thing is, I haven't got involved with oil this time because the trouble is OPEC has got a. Goldman Sachs this week was saying that OPEC had got 6.5 million barrels of spare capacity. And so, after the OPEC Plus meeting last week, where they've agreed to kind of slowly reduce the voluntary extra cuts, that's going to add 2.2 million barrels over next year. It's difficult to see oil making much headway against that backdrop. Plus, they've got this ongoing, they're in the process of recalculating base production targets, which probably will result in an extra 600,000 barrels a day coming on from the UAE and Iraq. So I think oil is not going to go anywhere. On my portfolio, it's been shit. I talk about it every week. I've got it wrong. Not much fun. But the latest data from the US, I think, monetary policy works with long and variable lags. And the JOLTS data out this week shows that the jobs market in the US is absolutely slowing. And if it keeps on going, then unemployment should tick up. Now, are we going to have a deep recession in the US? Doesn't look like it. Are we going to have a slowdown? I think so.
Yeah.
So, the thing is, I'm going to stick with it because I just think, I just don't understand how equities are taking off when, if the US economy slows, then, corporate earnings growth will be negative. Now, actually, this week in the weekly, I've done a calculation based on last week's data from the first quarter, which showed that the US total corporate profits in Q1 actually fell by 57 billion. And so I've backed out the net change in aggregate S&P 500 earnings over Q1, and it implies that in the rest of the US economy outside the S&P 500, earnings fell by about 3% in Q1. So the US economy is not doing great. In fact, aggregate earnings for the S&P 500 actually fell by about 0.9% in Q1. Earnings per share rose because the share count keeps on falling due to buybacks, but aggregate earnings were down. And as the US economy slows, I just don't see how equities can keep on rising. So I've got it totally wrong so far, but I think as an investor, you just have to stick to your strategy. And it hasn't worked. I've lost a lot of money, but I still believe that higher interest rates are unsustainable in the long term. Obviously, if Biden were to start actually having a sensible fiscal policy, that would help me. But sadly, there doesn't seem any prospect of that on the horizon.
So
anyway, that's my summary, Rogue.
Well, thanks. And we're kind of what's good is actually we're both on opposite ends of the trade, because I'm thinking I'm only a third of the way in, but I'm thinking of betting on banks on the bet that interest rates are going to stay high. you're in the opposite trade that interest rates are going to go down. So
Yeah,
so
but in the
this
short term,
mm,
I'm with you.
mm.
I think short term rates stay high, but I think monetary policy still does work. And as higher interest rates slowly feed through to the economy, they will slow the economy.
So we can perhaps talk about the S&P and the FTSE and the macro in a short bit, and then test our opposing arguments and perhaps criticize each other's thesis there, which is great. It's
Yeah.
better to have opposing thoughts than everyone just agreeing. And PHS has said that the problem with banks is they're so opaque, you can't be sure on what's happening on their assets and liabilities, and that's true.
I mean, that's what happened in 2008.
Now, I think I could. Now, I could actually go and get a bank's balance sheet and discuss that now. But I think just thinking of we've only got 2 hours max.
Yeah.
What I'll do is we'll park that to the end, but also in the future, I'll perhaps do a presentation on a bank, and then we can go
Okay,
into
great.
detail what is in a bank's balance sheet. But yeah, you're right, and I'll touch on that a bit later when we talk about capital ratios. So in my case, okay, it's here. So not much has changed. I mean, actually, a bit of a. No, it's actually still that 10% because I looked
Very good.
earlier today.
Good for you.
But a few
Doing much better than me.
challenges this week. But actually, generally, not much change from last month. And no changes here, but just stuff I thought that was big enough to report on was uranium and oil were both looking embattled at the moment. And also India was very interesting this week.
Yeah.
So to start with uranium, and as you can see, it's been really crashing. And okay, I think this is best off on TradingView to look at this data.
Yeah.
So
it's not really a crash, though, is it? I mean, it's a bit of a correction.
Yes. So for me, I found this alarming, though, because also I did have like a little, technical pattern I drew. But it's kind of, yeah, I don't know. For me, it's been a bit alarming. However, I reminded myself that my game plan for uranium, which I wrote down, is to trade it not on the yellow cake price because that can have up to a 20% discount to NAV, but on the actual uranium price. And I've got this trailing stop loss. And so actually, in light of that, we're still in a good position. We seem to be just following the top of this channel. And we're at $91. And so actually, I was a bit alarmed, and I've seen the value of my uranium drop. But yeah, I'm still can relax until I see this challenged. So
okay, I can't post into the chat for some reason, which is really, really annoying. I can't like paste into the chat. But I've just looked at the uranium price, and it's flat. It hasn't fallen.
Yes, you're correct. So I have the The Numerico is the best website for checking that out. Oh, yeah, leave the site. Okay. Didn't know it was going to do that. So this is which is presumably what you're looking at.
Well, I'm looking at trading economics.
Right. Well, this one's slightly more updated, more more up to date than trading economics, but this is probably what you see on trading.
Yeah, it is. Yeah.
Oh no, sorry, that's intraday. So you'd
Well, I'm
see
seeing
this. You'd
the
see
other one.
this.
Yeah.
Yeah. So you're right. It is, I guess, flat. But I was a bit concerned with this, with the yellow cake price, which is kind of a lot more volatile. And so I don't. So I'm just waiting for it to load up. Sorry. So okay, so my computer's dying. So okay. Anyway, uranium looks for me quite alarming on here. With this drop, I don't know. It seems to be. It's 10% of my portfolio, I should say.
Okay. I can only load up screenshots, so files. So I've loaded up a screenshot of uranium.
15%.
And you can see it's going absolutely nowhere. It hasn't collapsed.
Okay, I can't see a screenshot, but the thing is, PHS can you add things to the chat?
Yeah, no, it will be a problem with me. It's my computer. I need to reboot it, but
okay.
It's actually posting files to the because I can normally paste images into the chat, and tonight I can't, which is annoying.
Okay, well oh yeah, now that does look a lot flatter.
Yeah.
Than
So
my one. Yeah.
So what I take it's happening, Rogue, is I think retail investors have got bored with uranium going nowhere, and they've started to sell yellow cake.
Yes, and that's yeah. And that's the problem with yellow cake is it never has traded at NAV, and you do have to worry about that. However, maybe one day there could be a time when retail come in, if there was a mania, and then when you saw that it was trading at a premium to NAV, then that's probably the time to sell.
Yeah, absolutely.
But it is annoying how it never does trade at NAV though. That is a frustration with yellow cake, and a lot of UK stocks, ETFs and things in the UK. It's exactly the same story.
Yeah. So how are you expressing your oil trade?
So, okay, so that moves me on to the next thing, which is oil.
Yeah.
And as you can see, oil has crashed this week, but it's still at 76, but still, didn't look good.
Yeah.
Now, I have roughly 10% again of my portfolio in oil stocks, in Total Energies and Shell. And so that's how I'm expressing my oil. I don't count rock copper. That's not counted. That's just one of my speculative plays.
Yeah.
So I mean, I was a bit, I was a little bit ruffled by this. However, I realised that actually this stop loss I have is only a 12% drop from where we are. So actually, I don't mind losing 12%, and I'm just going to hold on, hope that I can hold these for many years and get dividends. But
Yeah.
at the end of the day, if we drop below this stop loss, I'll have to
Yeah.
close my oil positions. And however, they are kind of in the end game anyway, really. So it's probably for the good to refresh and renew.
Yeah.
What's I mean, I wonder. No, Simon isn't here. He'd be good to
No,
ask
sadly,
him.
Simon's not here tonight.
But what's your thoughts? Does anyone have any thoughts on oil? Then generally, do you think it's there? It's going to drop now as a long-term trend?
I think long term, I think oil will do really well because it just haven't had the investment. Above all, shale looks like it's tapping out.
Oh,
And so when you look back at the last 20 years, you had extraordinary growth from shale. And I mean, when you look at, total oil production growth, it's all shale. And that now looks like it's peaking. So if oil consumption continues to hold up, then you're going to need a new source of oil growth. Now, the thing is, there are various new basins. So there's Guyana, and you're talking about 1.8 million barrels a day, I believe, when it hits its peak. And then you've got offshore Namibia. But there's really not much else. So there's UAE's growing. Saudi, the thing about Saudi is they've decided not to invest to boost their production to 13 million barrels. But what matters for Saudi production exports is not their total production, it's how much they burn for domestic consumption. And Saudi is investing huge amounts in solar, in wind, and now in nuclear. And that means it will be consuming less oil to burn for electricity, which means it can export more. So long term, I think, there's a strong bullish case for oil. In the short term, OPEC's got too much capacity. OPEC are boosting production over the next year. US shale still has growth. Ghana's coming online, etc., etc. Sorry, Guyana's coming online. I can't see a strong bull case for oil short term.
no.
And I don't like the prices of oil companies at the moment. I think, you buy oil when everyone hates it and the prices are rock bottom. I don't think you buy them now when they're, pretty much all-time highs.
They're at the long-term high trend.
Yeah.
So PHS has said no one saw the shale coming. Who's to say what the next big source will be? And if someone told you in 2000 that US would be the world's biggest oil producer and would become a major exporter in the next 15 years, would you have believed them? And so,
well, can I get so when I had a job as a investment analyst, investment manager, I went along to some of the presentations by some of the shale oil companies, and it was clear to me then that oil production from the US was going to absolutely go mad. because the economics for what they were talking about for the shale oil wells just looked absolutely compelling. And that meant you were going to get a huge increase in oil production from the US. And I didn't invest in shale at the time because I thought they would flood the market and collapse the price and their profitability would be awful. And I was right. But what happened later was that, they did have pricing power because it took 10 years, but then investment elsewhere collapsed. And so now, shale oil is making good money. In the early days, they didn't make good money.
And perhaps will the Saudis be able to use shale to get loads of oil out when their conventional resources run out?
Yeah. Now, somebody may correct me, but the Saudis have just discovered loads of shale, but isn't it gas? And I believe that Saudi have got shale gas, but they're going to get out a lot of natural gas liquids with that gas, and hence one of the reasons they have decided not to invest in boosting oil production to 13 million barrels a day is they don't need to. So at PHS, what's the pig cycle? Question.
So we'll wait for a response. And
Sorry, was I on mute? I was just going to say, this was what we learned at economics A level. The scarcity of pigs. All the pig farmers would produce lots more pigs. They'd all come onto the market at the same time, and the price would crash. Nobody could make any money selling them, so they stopped producing. Supply goes down, the price goes back up, and it's just a constant back and forth.
Yeah, absolutely. So I'm actually a member of an economics book club, which is as nerdy as it sounds. And the best book that we've read is a book called The Prize by Daniel Yergin, which is a history of oil. And it's always subject to boom and bust cycles. And so OPEC basically were created to try and control the supply to get rid of the boom and bust cycles. But whenever there's a price spike, then everyone makes loads of money, loads of investment goes in, and then 5 years down the line, you have a glut. And so we've talked about this previously, but when, do you remember peak oil? Like 5 years ago, 10 years ago, everyone was worried about peak oil. And I did a lot of reading about peak oil. And what I discovered was that actually there are essentially an infinite amount of hydrocarbons on this planet. So methyl hydrates are these complexes between methane and ice that form on the ocean floor under certain low temperatures and high pressures. And there are enough methyl hydrates in the world that if you were to burn them all, you'd use up all the oxygen in the atmosphere. So there's essentially there's an infinite resource of hydrocarbons if you chose to burn them. But burning them all would be obviously a very bad thing.
Yeah.
But when it comes to hydrocarbon availability, it's just a question of price. If we need it, we'll find a way of producing them.
Is there a kind of general economics textbook you could recommend you know, that could have been useful for this work I'm doing on banking, but also generally just covers all the basic parts of economics in one textbook. You know, the kind of thing they give to university first years.
Yeah.
Is there one you could recommend, or
Actually, you're asking the wrong man, Rogue, because I didn't do an economics degree. I did a master's.
But you said you're in a book club.
Yeah, but we don't really read, economics, but 101. What we read is books about specific topics. Frankly, the last one we read was on the Argentinian debt default of 2001 to 2013, and Elliott, the the U.S. hedge fund manager, pursued them through the courts for the next 10 years. That's the sort of thing we read.
Wow. Well, Argentina come up later actually in one of my slides.
Yeah, I'm sure.
So the other thing was India. So India, actually, it's changed from here, but obviously I was using a spread betting account to emulate a sizable position. And what happened was it was the Indian elections. And the results came out yesterday. And what happened was, in fact, you need to look at this on the daily to see it. There's actually, you might just be able to see it, but there's a tiny island up here where my pointer is. So it jumped up massively 2 days ago, and that's because the exit polls came out. By the way, someone's got their mic on, and there's some background noise. And yeah, so thanks. So there's like an island here where the polls came out saying that Prime Minister Modi was absolutely miles ahead of everyone else. And then when the results started coming in, we had this massive crash. And actually, I looked at my spread betting account on that night, and there was a sizable package there. And but then the next day, it was just devastating, all wiped out. So I'm now back to where I started. I didn't close the trade, but it was very exciting. So here we've got the results for the Indian elections, and yeah, you can see Modi's party there. Only 240 seats. Now he's in a coalition as well, but still he's not made the majority he needed. However, it looks like that was just a election day special, and it's kind of business as usual. And when I was actually watching the coverage live, and one of the pollsters actually started crying. So I'll just play that. Let me know, because basically the pollsters have just got it all completely wrong. And watch this. Let me know if you can't hear it.
Congress by a big number.
So the NDA vote share,
Congress is 23.
Your NDA vote share was in the high 40s.
Yeah.
The NDA vote share actually is now only 45. Your India Alliance vote share was in the late 30s. The India Alliance vote share is in the early 40s.
Yeah, let me tell you. So we predicted for NDA 47%, exit 47%, 45 is here, 2% down. So there, and for India Alliance, we projected 39%, so which is 3% up. That's the swing which took place.
5% swing has damaged.
And this is in a 2% is well within the era.
Okay, so we'll have Pradeep with us. You know, the good thing is he's being magnanimous. He's apologized for the error. And the fact is, unlike Rajdeep, I don't believe that the channels have nothing to do with it. It's a team, it's a partnership. So we got this wrong. Make no mistake about that. But, you know, he worked really hard. 4 times he went and did this poll. So we thank you for your effort. And you win some and you lose some. He still has a fabulous track record in terms of polling.
Now you made him, oh God.
No, but the thing is, listen.
Sir,
Pradeep, come on. Here's the thing. Here's the thing. You know, in life you can't get all right. Okay, in life you can't get all right. There's a lot of rigor and effort that goes in, and we've been. If you look at all our posts and our coverage during the post poll,
Where did you find that,
we were
Ray?
constantly
That's
saying,
amazing.
let's not get carried away. It's a post poll. It's directional. The reality.
I watched it. I was actually watched it happen live.
Wow.
Yeah, I watched that happen live, and then managed to get a clip. I'll stick it on the in the chat. So yeah. So obviously they had the polls had it one way, and then the voting was completely the other way, and that explained that. So actually we're back to where we start now, but still it's been an exciting start to my India investment. So
Very good.
So okay, well those are the bombs going off in my portfolio. We could move on now to the S&P 500, and you described. We should try and be quick here because I've got probably a particularly long one later presentation today. But yeah, so you touched on it earlier, and when I bring up the S&P 500 here, and it's off to the races again. Actually, now
It is. Yeah, it is.
now I've got it myself. I've got this channel, which is slightly different to the channel we drew with Simon last month. I think this is the top, and you know, there could be. I mean, my base case is that we're going to be following this 16% gradient, all hail New Keynesian economics, and this is the channel we'll be in, and that's what I think. And you know, we could fall back 15% or something in, you know, but still stay in this channel, and that's my base case. And until you've already explained the macro, and I agree. It's although for me, I think inflation's still a little on the high side. I mean, here's my quarterly measurement of inflation. I have it at about, you know, 1.5% a quarter. So
Yeah.
you know,
The thing is, Ray, you know, if you watch the weekly I've done, you know, obviously because I've got a huge bond trade on, that I focus on inflation a lot. And, you know, when you dig into the numbers, inflation is persistently high. There's no question about that. But the reason it's high is largely because of lagging effects. So in the US, it is owner's equivalent rent and rental inflation, both of which are lagging. Particular owner's equivalent rent is just a ridiculous thing the Fed has made up and lags by about a year. So that is going to stay high for a long time. And also it is home insurance and car insurance, which are still catching up with a big increase in inflation over the last couple of years, and also changes in driver behavior. And if you strip all that out, inflation in the US is below 2%. So I don't think there's a big problem with inflation. I think, but having said that, the market's worried about inflation, which means interest rates will stay higher for longer. And I think that means the economy will slow down. When you look at the JOLTS job report that was out yesterday, and frankly, all the data on the US labor market, it really looks like the US labor market is slowing. Now, in the weekly this week, we have a big deep dive into those numbers. And frankly, the numbers, the real numbers, are probably even worse than the JOLTS job report reports. However, the US economy is still doing okay. You know, the ISM services numbers out today were strong. So lots of contradictory data, but real interest rates in the US are rising as inflation falls. And I think eventually they do slow the US economy.
I mean, I guess from my viewpoint, if I see this drop, then that disproves my hypothesis then. And so I got to keep a good eye on inflation.
Yeah.
Um,
The other thing is that there's very strong seasonality in both the US, UK, and Eurozone. So in the US and the Eurozone, the CPI numbers are seasonally adjusted. But the question is whether they're seasonally adjusted enough. Inflation tends to slow down in the second half of the year. In the UK, most of the inflation happens between February and May.
yeah.
And we've just come out of that period. And the CPI numbers are not seasonally adjusted. So, touch wood.
Yeah. I mean,
inflation starts to come down.
I mean, a couple of arguments that would agree with your position that occurred to me lately was, for example, the dropping oil price.
Yeah.
And also, why did Richie Sunak leave post the election as soon as possible? Does he know what's in store is bad, and is that why he wants to hand over?
Well, I think he knows it's not going to get any better.
Because he would know, presumably,
Yeah.
he would as good of an idea as anyone if that was going to happen.
Yeah, I think that's true.
So okay, then the UK and we're actually that's the FTSE 100, which doesn't really tell us anything. The FTSE 250, which I found gives us a better picture of what's actually going on with UK equities.
Yeah.
It's absolutely in this, or I called it the all hail New Keynesian economics, but it's in a very good trend at the moment. So I mean, I would say, I mean, my base case, which is obviously different to yours, but my base case here is that yes, okay, we look very tame at the moment. Actually, inflation is still high in the UK.
Yes, services inflation in the UK remains persistent, but again, I think that is all due to lag effects. So, particularly when you mandate an increase in the the national minimum wage of 9.8% in April, wage inflation is going to stay high, which means that inflation is going to stay high for a bit. But the best predictor of future inflation is historic inflation. As inflation comes down, future inflation should come down.
And we're kind of, in terms of GDP growth, tame, weak. We could, but we are out of recession. We were in recession previous quarter. We're now out of recession. But really, the way I feel, I think I've got a deja vu 2010 feeling. Like I could remember in 2010, and 2009, and then moving into 2010. I'm naturally like an Austrian economist kind of thing, and So
Yeah.
I was waiting for doomsday, and I watched endless Peter Schiff and Mark Farber and Jim Rogers interviews for
Yeah.
years afterwards. But I can remember in about 2010, but basically what they said never happened. And in
Yeah.
2010, I mean, I can remember you'd hear these big hyped up news stories about factories going bust and companies being shut down. But I can clearly remember um, going to the Nando's restaurant,
Yeah.
and it was packed with people.
Yeah.
And so I've got this 2009 feeling. I think, although we've kind of have had tough times, and even in the data, actually, the market's the market moves before the macro stats do. And I think we, even if we have a gentle rest of the year, or a harsh rest of the year, I think, my base case is all hail New Keynesian economics.
Well, I mean, where I absolutely agree with you, Rogue, is I do not believe that we're going to have an enormous economic collapse. In fact, basically, my bet is on the resilience of the financial system. So I think that interest rates will come down and the economy will just carry on. What I do think is that when I look at equity valuations, they just seem silly to me. I do not think that corporate earnings growth in totem has risen much over the last few years. And, when you look at in Q1, for example, the S&P had a fantastic period, but earnings growth was really not very much at all, earnings per share growth. And so what's happened is that, future expectations rose. And you can't keep on doing that forever. At some stage, your heightened earnings growth expectations collide with reality. And at that stage, equities have a correction. And I never buy. So the thing is, in my life, I've been out of the market for years, and actually, long term, I've done well by
Yes.
just waiting for something to happen. And right now, I don't look very clever. I have to go on the podcast every week and say how badly I'm doing. It doesn't make me feel very good or look very clever, but I'm happy to do that for years. And then there's always something comes up.
Mm.
Then you buy.
I mean,
And you always buy. I always buy too early. Gone.
You've got a lot of experience, and I know from your previous job, this was your job to analyze this, and you've got a lot of expertise on looking at these macro factors. Now, I don't know whether I'm right or not with my counter opinion here. I've got less experience for you by far, but I've kind of formed a theory that's my kind of base case that since 2009 we've kind of gone into this Keynesian dream world where they are going to just print and print and print. And for me, there's like a correlation between money supply and the stock market, the equities. And so that's why I've kind of formed this opinion that, when you look at the S&P 500, for example, going back to, I mean, this only goes back to 2015, but I've drawn it going all the way back. And I think that ever since 2009, this is the Keynesian dream world. And so I think that perhaps some of the boom and bust cycles of the past before 2009 aren't really going to happen. And I believe that and I discussed this later in my presentation, but I think it's all going to blow up eventually. But that's my kind of current base case. However, let's see, because I could well be wrong, and so I've got to really think about what this danger is that you've presented and how I can perhaps protect myself.
Well, the thing is, Rogue, I would say, and I've just posted this piece from this week's weekly, making your point that there is a strong correlation since in this case 2020, between bank reserves and the level of the S&P 500. So I'm actually surprised that bank reserves are growing again, given that the money supply, M3, in the US is not really growing at all.
Yes.
So M2 is the US money supply preferred. Let me see if I can find this. So yeah, because certainly the growth in the US stock market has absolutely outstripped the growth in M2 over the last few months. But yeah, since 2023. The trouble is I can't cut and paste. Yeah,
I've got here M2 and M1. These are the US. The US use M2 and M1, don't they? But okay, well, perhaps we'll return to that then. I guess we should get on with the banking presentation.
Yeah.
Thanks a lot, Sayet, for joining us, and Lodley Pool. And I saw a comment from PHS. He's saying that the growing real wages will be a source of demand in the economy. The first sustained period in 15 years. There's a switch back to returns on labour at the expense on returns on capital. Even more so with the incoming Labour government. But the last 50 years showed that creating more bank reserves, while it might have shored up the banking system, it didn't do much for the aggregate demand in the economy. Would that be a reason for me to not invest in banks? I wonder. Perhaps you could reply.
The thing is,
chat.
If banks, what so far has held up very well is the credit cycle.
Yeah.
The thing is, I can't cut and paste into the chat currently, which is really annoying. So I've tried to save something via Paint, and it hasn't really worked, I'm afraid. Oh, that's the US money supply. Anyway, you can see that the US money supply has not really increased over the last couple of years. Anyway.
No, you're right. It's gone down. And actually, I think, I mean, here's that same chart, actually. So the M2 is the total money supply. And you're right, it has gone down, but you can see it's nudging up again. And,
it is, but the S&P 500 is off to the races, so
But I think that this is an exponential curve, and I think this is a blip because of COVID spending. But now that we're back up to the trend, I'm expecting this to follow up in a exponential trend until the dollar collapses. But that won't be actually.
A long time.
Yeah, that won't be for decades, because although it kind of looks scary, this rate, if you actually go on to the Fred website and zoom in to just say the last 5 years, it stretches out and you see it isn't actually quite so scary as it looks at this scale. But I think we're into that log phase of of nature, and that natural phenomenon of being in the log phase. If you think of bacteria in a petri dish or something, and it will inevitably collapse, but it won't be. We've still got some sunshine for a while. I mean that's kind of my
Well,
key base assumption, like I say, but it's not that I'm any expert or anything, but that's my base case.
the thing is, right, what I'd say is I would never underestimate the Americans. You know, when they decide that something needs to be done, they do it. And if they decide that the national debt is a problem, I would, they'll deal with it.
Yeah. Well, I think they could keep the. Um, you see, I think that their fiscal indiscipline is going to keep the interest rates high, even if there
Now,
was. Yeah, and
but
I because of their fiscal indiscipline, like they've got inflate. Even if inflation moderates, and
yeah,
I would argue that inflation is in the US high still, based
yeah,
because I use quarterly prints, but from what I do, I say it's high.
yeah,
And but not only that, but they've got horrendous fiscal indiscipline, and so that makes the bonds less attractive to buy for international investors because of their fiscal indiscipline. So so I'm
mm,
that's just me asserting my high base case really for interest rates, but um,
yeah,
I'm glad that we have a open discussion on your
yeah.
Discord channel. It's not
Well,
that
right
I can.
now I'm not looking very clever, as you all know. So everyone
So,
else has been more right than me.
but let's see how it develops. But so PHS has said my investment in NatWest in 2008 has put me off banks. I didn't know what I was doing at the time. Probably still don't. Why will it inevitably collapse? What would the mechanism of collapse be? And I think by that he means the dollar. Um, well, really, as we were discussing before, really you end up. Well, look at the British Empire. Um, why did the British
Yeah,
Empire collapse? We were saying before. Was it the gold standard is why it collapsed, or was it just it it's because of the First World War, but it was kind of
yeah, I agree.
collapsing anyway before then. But
Yeah,
really, war,
no, I agree.
isn't it? You had the
Well, the First World War bankrupted the British.
yeah,
We spent vast amount, we spent just vast amounts of gold, and we went heavily into debt against to the Americans. It was, yeah. Without the First World War, the world would be a very different place.
yes,
That
and
is definitely true. British Empire and the United States, the two examples are not really analogous. I mean, the thing about the British Empire, the UK was only, even at its height, a relatively small proportion of the total world economy. Now, it was
Yeah,
heavily industrialized because it was the first to industrialize, so it had a technological advantage over everyone else. Which very briefly, I think at its height in the 1860s, we were something like 20% of the world's manufacturing capacity. Even then, at our absolute height, we were at the point where America is today. But the thing is, we were still a small, 20 at that time, about 25 million people. And even by 1900, we were still getting on to 40 million people. We were
yeah,
the smallest in population terms of great powers. And while
yeah,
we had a high per capita income, You know, that we'd already been overtaken. The US overtook us in terms of our economy in the certainly by 1870.
Yeah.
And Germany had overtaken us by 1900. I mean, in per capita terms, we were still the wealthiest country in the world, but we weren't even the biggest economy. We probably never actually overtook China in gross economic output.
Yeah.
I mean,
in terms of GDP per capita, which is what's important.
oh yeah, no, absolutely. But in terms of the actual gross economic output underpinning the British Empire,
Yeah.
it was actually pretty. We were balancing an awful lot on, frankly, a pretty small economy overall.
Yeah, and I also
while-
think that, well, that's a very good point. I also think most people don't realise how late most of the British Empire was acquired.
Exactly.
You know, it was like late 19th century, and a lot of those holdings, you know, we did own much of the world, but we had rather a tenuous hold on it, and we were only going to hold it as long as it was sort of economic to do so. And when the balance tipped from it being profitable to it being unprofitable, then you know, I think it was always going to unwind.
And much of the latter empire, basically the bits of Africa there, I mean, the British didn't really want to put their flags in there. They were much happier wanting just to keep them as markets. But it was only, I mean, it's basically the Congress of Berlin, 1885, that suddenly led to Africa basically having its map being painted by various, and so Britain did it in some way. I mean, we had various points, you know, places like Freetown and obviously South Africa around Cape Town, the Cape Colony, and places like Zanzibar, you know, island dots. But most of it was not, you know, the territorial bit didn't happen until the hand was forced at the Congress of Berlin, basically to keep the French out.
Well, but in addition, a lot of it wasn't really voluntary. So, you know, a lot of the African territories, British adventurers would go out and add it to the empire. And if you look at, for example, how Britain acquired Fiji, so the King of Fiji had a problem. So the Germans were sailing around, the Americans were sailing around, and the British were sailing around. And they all had gunboats. And if one of his citizens got into a spat with, let's say, the Germans would sail in, they'd shoot up a village and demand, you know, repatriations because of this commercial dispute with one of the Germans, and just take what they wanted. Same with the Americans. And so the King of Fiji felt he needed the protection of one of the great powers to stop the predations of the others. And so he wrote to the Americans asking if he could join America, and the Americans never replied. So he then wrote to the British, and the British, with their positions in Australia, were building up their empire in the Pacific, and replied positively. So you kind of get the vision of, you know, these smaller states around the world, you know, were faced with these, you know, mafia families, if you think of it that way, and they needed to join one of them to protect them against all the others.
The funny thing is, oh, sorry.
No, you go ahead. Sorry, you go ahead.
I was going to say, because wasn't Fiji? It wasn't that they petitioned the British government. They actually petitioned the British colony of Queensland, and it was the Queensland government. So they became a colony, and that was it. The British Empire, the colonies had colonies.
Yes.
effectively. That's what happened with Papua New Guinea as well, or the southern half of Papua New Guinea was basically colonized. And Disraeli had a term for it. He called it prancing proconsul.
Right. Yeah.
Specifically in that case, because of I guess you guys are all familiar with Adalawanda, Zulu Dawn, and it was
Yes.
basically the British governor, Lord Chelmsford, basically decided off his own back that he was going to teach the King of Zululand a lesson, and got his army destroyed at Adalawanda, and of course that caused the crisis back home. And the other classic one, is the Suez Canal and how Britain came to control the Suez Canal. So when the canal was created, it was 50% belonged to the Suez Company who built it, and 50% belonged to the Khedive of Egypt, the King of Egypt at the time. He got into financial distress, so he sold 7/16 of it to the British government, and the Disraeli's British government bought it.
Yes.
Because it was a strategic lifeline. And he was promptly condemned by the then leader of the opposition, who was Gladstone, for entangling Britain into another potential, we'd have to go and save it anyway. A few years later, there were anti foreigner riots in Egypt. So Britain, and partly because Egypt had gone bankrupt again, and Britain had to send warships and troops to defend its interests in the form of the Suez Canal. And guess who it was who actually was forced to do that? None other than Mr. Gladstone himself, who condemned the whole concept of empire, but ended up adding Egypt, and then from Egypt became Sudan. And that's how we got into the whole thing of because Egypt, in theory, owned, was the predominant power in Sudan. Of course, Egypt had become a client kingdom, so we sent Gordon over to put down the rebellion of the Mahdi in Sudan, and he got himself killed, which besmirched Britain's reputation. And so 10 years later, we sent an army to restore our reputation, and ended up, and that's how we conquered Sudan. So it's all these local things, not the actual, what was it? Britain gained an empire in a fit of absent-mindedness.
Yes, absolutely. So, what's your background, PHS? You've got very good knowledge about, history.
Entirely amateur. Read history books, basically. That's I like to read history for all sorts of history, not just the British Empire, but any sort of history. It's a huge source of so much stuff. And with the internet now, I mean, not that I'm saying everything you read on the internet is going to be true, but there's so many sources about,
Yeah. So I read quite a lot of history, but I'm 2/3 of the way through Jan Morris's Pax Britannica trilogy about the British Empire. So I've read the first 2 volumes, which were both fantastic. The first volume in particular, where he talks about Fiji, are really good. If you haven't read it, I recommend it.
Great.
Look out for that one, definitely.
So that's great discussion. What I was going to add was around then, if you were a leader of a tenuous estate that was under threat from all kinds of enemies, it must have been very, it must have been very tempting for them to basically do a deal with the British to say, okay, you take over the country, but I obviously keep the ruling elite well fed with money. But it must have been quite tempting for political leaders to cede power to the to have the British as protectors.
I don't think it was necessarily voluntary in most cases. It was more as Keith was describing about the Fiji. It was the case of here's an offer you can't refuse.
Yes.
You stay in. You stay if you do what we want in terms of trade and foreign relations. we'll leave you in power and we'll leave you to run the internal part of your country. I mean, that's effectively what happened in India. But the thing about it, though, is that it wasn't conscious policy generally from British government. I mean,
Yeah.
India was, of course, the East India Company, but they get themselves into scraps, and it becomes
Yeah.
the honour of the flag type thing that then calls the British government has to come in to get them out of the hole they've dug themselves into, or they've overextended themselves.
Yeah.
And that's how it tended to be.
So, I mean, I guess the US is
US
has this superpower status now, but you know, but all empires end. So who knows?
The thing is, it's the US's power, and this is the fundamental difference between it and, say, Britain in the 19th century. I mean, you look at America. Look at it on the map. It's 3.7 million square miles. Now you could say, okay, Russia is a lot more, twice the size, but most of Russia is largely uninhabitable, whereas the vast majority of the United States is habitable land. Not only that, it is massively packed with resources, not just physical resources, but I mean, one statistic, and I don't know if it's true, but apparently the United States has more navigable waterways than the rest of the world put together, in terms of the Mississippi Delta and the Missouri and the fresh water supplies that brings, which then support its agriculture. And it has a huge, relatively speaking, it has a huge population. I mean, the only two countries with bigger populations are China and India. But the difference is that America's per capita income is, greater than most European countries, developed European countries. So it combines both a high economic output per worker with a huge number of workers. Its population is relatively young by Western standards and growing relatively. It's got no problem in topping up its population whenever it needs to in the form of immigration. And while, of course, that's always a controversial subject, the fact is, America is reasonably good at absorbing those and turning them into useful, productive people. So,
also,
I don't see. Sorry, go ahead.
No, I'll just say, also, it's easy to defend. It's very difficult to invade America versus most other places.
Well, it's not difficult, it's impossible. As a practical proposition. I mean, you look at what it took to invade continental D-Day's coming up tomorrow, the anniversary. You look at the effort that needed to go in. I mean, the combined power of basically Britain, the United States, and Canada. They had to, and that was to get across the body of water that was at the point that they were doing it about 120 miles.
Yeah.
Now you try. Now the fact is, America today is an awful lot, arguably in many ways, an awful lot more powerful than, certainly in potentia, than Nazi Germany occupation of Western Europe was.
Yeah.
And it's got a 3,000-mile body of water, covered by far the world's most powerful navy. The idea that anybody could ever harm the poor of the United States except by an all-out nuclear war, it's completely invulnerable, save for that last thing. But of course, with an all-out nuclear war, would be complete destruction on. They might be able to destroy America, but they'll be destroying themselves at the same time.
Absolutely.
Yeah.
So it's essentially invulnerable.
Yeah, I agree. Do you know what? You've really filled me with optimism and high spirits, PHS. Actually, the way you put that, I'm feeling a bit more confident about the future. Actually,
yeah. The thing I'd say, Rogue, is everyone's always talking about the end of the world, end of the financial system, but it never happens because, people aren't stupid. When things get too far, when you look at what happened to the US during the financial crisis, the US were really ruthless in clearing up the mess caused by subprime. They allowed Lehman to go bust, and they dealt with it in a way that other economies around the world had a much more muddle through sort of way. The Americans wrote things off, got back to square one, started growing again. And when people talk about the debt being out of control, the debt is out of control in the US. That's because nobody cares about it. When they start to worry about it, I have full confidence the US will do something. It might not be comfortable, but they'll do something. Because the alternative of the US government goes bust and all the bonds get written off is just totally unthinkable.
Yeah, no, that's true. But I suppose the danger when it comes to the US is not so much what might happen to the US itself, but the US is sort of, to some extent, disengaging from the rest of the world. Going back, doing what it did after World War One. Again, because it is so vast and is potentially, if not in actuality, it certainly has the potential to be actually almost an autarkic economy. And because it has there's very few things that if it doesn't want to do that it can't do for itself. I mean, there's very few in terms of raw materials, food. It's got the industrial base, it's got the technological base, it's got a huge amount of capital built up. So it doesn't. It is probably one of the very few countries in the world that could. Well, it doesn't. I mean, trade is not a big part of the American economy. International trade. I mean, it is It is the world's biggest trader, but that's a function of its economy being so big. But the actual proportion of its economy that is involved in trade is actually it's only about 10%, I think.
Yes, that's absolutely right. Trade is only about 10% of the US economy, whereas it's 30% plus of a UK economy.
Yeah. I mean,
well,
sorry, go ahead.
No, I was just going to say this makes me feel a lot less pessimistic about the future of the US and the UK.
I mean,
right.
I mean, I can see clouds on the horizon, and I don't necessarily think everything's going to be a ray of sunshine over the next few decades. But I think the idea that somehow we can film that was it Civil War is going to be the next the fate. I don't think so at all. Frankly, I think it's far more likely something along those lines would happen in Europe rather than the United States.
So
I agree.
There'll be like a power. Now, the one thing, one of the themes of the presentation is that the US dollar does dominate. Is that the current fiat system is great for the US but horrible for everyone else. And actually, one slide that highlights that is down here. Is here you can see the bankruptcies before Bretton Woods and after, and you can see that following the adoption of the US dollar and the totally fiat reserve currency system, you can see that the number of countries going bankrupt has gone up tremendously. I mean, whereas before it was kind of rare cases and always because of a war.
I see, got you.
Now everyone's going bankrupt. All of the poorer countries are basically routinely going bankrupt, and then they get saved by the IMF. But that's kind of part of the aim as well. The IMF was set up by America, so these countries all become kind of beggar countries, really.
Well, the thing is, Rogue, the flip side of that is that the reason they're going bust is that they can borrow more money under the current system. Under the old system, you particular trade deficits had to be paid for essentially in gold. So it's difficult to run large trade deficits for a long period of time. Whereas now you can just take on debt, dollar debt, and that means that the imbalances are much larger, and countries can get into trouble in a way they couldn't really under the gold standard. But economic growth, the flip side of that is economic growth has been much better.
I mean, the gold standard is inherent. I mean, I guess you're going to be doing it in your next weekly, but the gold standard is inherently deflationary.
Yeah.
Because the ultimate monetary base is, if not absolutely fixed, then is certainly pretty fixed.
Yeah.
Now, arguably the problem with the euro-dollar system at the moment, I mean, there's the whole history of the euro-dollar and how it came to be. In fact, apparently the ironic thing is the euro-dollar, the first creators almost of the euro-dollar were actually the Soviets. But I'll cover that later. Talk about that later. But the problem with the euro-dollar at the moment is because effectively the rest of the world is operating on a fixed monetary standard, at least for its international commerce, namely the dollar, whereas the US, of course, has the monetary autonomy insofar as it can create dollars, whereas the rest of the world can't. But on the other hand, having a widely and universally accepted medium of exchange, well, that's one of the underpinnings of trade. If you didn't have the dollar, what would you use as instead? What could be more universally accepted and fungible than the dollar in our world? And what could you imagine that could replace it?
Yeah, I mean, I think that the way my kind of conclusion is that now under the fiat system, now that we've gone totally fiat, each individual state, okay, has a monopoly on violence.
Yeah.
So the populations within each state are forced to use the legal tender or the currency of that country and pay taxes. So because of modern technology, the states are a lot more stable than it used to be before. So you need a certain level of technology and control and power, military power, for all states to have this monopoly on violence in a stable way. And so really, all currencies are fiat, and it's just an interplay between all the different currencies. Because as within one particular country, the economy goes down the pan and they have less reserves and they're able to generate less taxes and they've got more fiscal deficit, the value of their currency will drop against the other currencies. And so you've got although fiat money I guess, has no tangible value, it is valued in the ability of each state to collect taxes.
Well, I mean, I guess there's two sides to it, isn't there? I mean, you've got the domestic you ultimately everyone needs, people need a medium of exchange that is recognised.
Yeah.
Within a country, at least a developed nation, who is the best institution to guarantee, a recognised medium of exchange. Well, that's going to be the government, not
Mm.
least. And the way the government can enforce that, it doesn't need violence. Although you can argue that all government, power of the state is at one remove its implied ability to exercise violence, but it doesn't need violence. All it does is say, right, we need you to pay your taxes, and we're going to only accept these bills that we produce, this currency, which works internally within a country. But then between countries, you need mediums of exchange. But then again, you need other people to be willing to accept your currency, or vice versa. And if they don't, then you can't have trade. So you need some agreed medium of exchange, and that just so happens to be US dollar, or not even the US dollar itself, but the credit creation process carried out by banks using US dollar denominated assets as the base upon which to create loans and all the rest of it, using the usual credit creation process.
So
And then
when
that funds trade.
well, see this graphic here, that's actually from a video you can get where you can see over time the world's reserve currencies changing, flipping from UK to the US. So I think even if the US was to, let's say they had a civil war, Trump versus Democrats civil war or something, you just see the pound sterling replaced by the other currencies, and I think the world could continue the current fiat system.
But
well, various people have proposed, using the IMF SDRs as replacement for the dollar, special drawing rights. But it hasn't happened. Basically,
is that the bank?
Well, the thing is,
which bank was that, Keith? That's
the IMF special drawing rights. So you would have that would be a replacement for the dollar in the monetary system, but it's perhaps PHS understands this better than I do, but it's basically the dollar is just much more convenient, is the bottom line.
Yeah, I mean, I don't know if you've ever seen any of it at all, but have you heard of the dollar milkshake theory?
Yes.
Brent Johnson. Yeah. I mean, he goes into quite a bit of detail, and also now his videos are very clickbaity. But I was going to say, Mr. Eurodollar University, forgotten the name. But the point is that the US didn't mandate everybody having to use dollars. I mean, you did have the IMF set up, and dollars were backed by gold, etc. And America did do a lot of initial lending, Marshall aid and all of that sort of thing to help rebuild Europe. But the euro dollar system sort of started in London and Paris of its own volition. The banks, I mean, nobody mandated, say, you must use dollars to carry out trade. And indeed, during the 50s, the pound was still a pretty big portion of the world. A lot of the world's transactions were still being so, potentially even more so than dollars. I mean, it only really petered out in the 60s as everyone started to realise that Britain was no longer what it had, in the wake of Suez and the collapse of the pound in 1967. It was banks did it because they found it convenient, and people who were transacting across borders simply found the dollar to be, or not even the dollar. I mean, it's not the dollar itself. It is the credit creation process. Whether it be export financing, financing guarantees, a Brazilian soybean merchant selling goods to, soybeans, say, to China. Well, he doesn't want renminbi for example, because what's he going to do with renminbi is not really a tradable currency unless he's buying equipment from China, which is always a possibility. That's fine, but what else can he do with renminbi? And if he just wants to park that money, where's he going to park it? Where can he what renminbi assets can he buy with his renminbi? Well, he can't really, because you know, Chinese domestic assets, because of the capital controls, you can't really. There's not really much of an international renminbi debt market, and you can't buy real Chinese assets. They don't let you. They're onshore companies. So what you're going to do with those? Nobody else is going to. If you want to then trade with, say, well, France isn't going to accept a, you know, buy some French goods with renminbi. Well, French won't want them. The thing that, you know, not in the quantities required, you know, to be able to provide the sort of liquidity. It's because there's such a huge amount of dollar liquidity out there in the form of dollar-based assets, whether that be dollar-based debt, dollar-based equities, and they are not. I mean, effectively, it's all the derivatives anyway, because most of it is not the actual assets themselves, but the loans taken out that are theoretically redeemable in those assets.
Yeah.
So that's just amazing comment, and I think I'm probably going to split this into two, actually, the presentation. But when I do the second bit, I really it'd be great if you were here, PHS, because you're able to read into the extra depth of these concepts, and yeah, it would be a blessing if you're here the next one.
I'll try to. I would just say,
Mm.
I am no expert. In many ways, I'm just regurgitating the various things I've read and heard from people who are, or at least seem to know more than I do.
I appreciate, but you have. I think you do. You may not be an expert, but you're knowledgeable. Let's put it that way.
Yeah.
You're knowledgeable.
So, yeah. No, it's been really interesting talking to you, PHS. Thanks for joining.
So I'll what I'll do is I'll do the I'll split this into two halves, and I'll do the history this time,
Okay.
and then that'll take us up to modern banking, and the modern banking bit, you know, I may even coordinate a bit with you, PHS, which to, you know, if possible, if you're not around for the next one, maybe save it for when you are around, because I think your kind of understanding of some of these concepts will be helpful when we get to that. But okay, so I'll just go ahead then. The banking system. So last time with the money, I went through how there's two basic human instincts, barter and debt, and how there's two kinds of money that stem from that: medium of exchange and money of account. And I explained how you had commodity money, representative money, and fiat money, and then how money of account has been tracked by humans using memory when you borrow some panini stickers off your mate at school, or lend some mate a fiver at the pub or something. It's memory. But then as we get more sophisticated, tally sticks, ledger books, the invention of double entry bookkeeping was very important. And then as we enter the computer age, database ledgers, and then now in the future, blockchain ledgers.
Yeah.
And we described that the worlds had different units of account, moving from a Dutch guilder that was backed by silver to the gold-backed sterling, to US dollars which are gold-backed, to now fiat US dollars. We, at the end of the last video I did on money, we realised the importance of money supply, which encompasses really all money, and how the banking system is actually a fractional reserve system, where only a small proportion of the, in fact, let's look at the UK one because it's slightly makes more sense to read. But basically, the bank reserves are a small proportion of the retail deposits and wholesale deposits, and the vast majority of money is basically has been created by just loans, people lending money, and a lot of this is things like mortgages and debts that companies have raised, and it is just incredible that only a small fraction of that is actually held as by banks in the fractional reserve system, and that money being fiat isn't actually anything anyway other than just numbers on a computer screen.
Yeah.
And we went through how there's public money and private money. Okay, so I'll just respond to that in a moment, PHS. So, okay, so public money and private money. So public money's the bank reserves, which the banks actually store at the central bank, even though it's the private bank's reserves, they're kept stored at the central bank and so are considered public money. And notes and coins in circulation, and then private money is the majority of the money supply, and that's actual people's bank deposits, and also wholesale bank deposits. But this includes loans, because when a bank lends you money, they basically just create the money on your, and then when you log into your, you have that cash which you could deposit wherever you like, but you then also have debt. So and then so my final conclusions at the last talk was the economy is limited by the confidence of banks to lend people money, and as fossil fuels and technology has created an enormous economy, the nature of money has had to adapt to catch up with the total money supply, and this increased money supply was enabled by the new banking technologies. And then we have here how you can see the money supply seems to be going up exponentially. So before I then start, having just recapped what we did, I'll just this is actually a very important point. So PHS has said that the term fractional reserves is arguably not correct. Now the thing is, when I looked up, well, when I've been doing this research, I found that by fractional reserve, I mean that the amount that the bank has on deposit, so the amount the bank has in reserves stored in the central bank, is a fraction of the amount on deposit. But what do you think is a better definition of fractional reserve?
So that is basically what I got taught at college when I was doing my economics A level. The bank has X amount in reserves and it lends out 90%, which then become deposits, and then it can lend out 90%, and so on and so on and so on. And that is how the thing grows. But actually, the bank doesn't lend reserves. The bank doesn't.
Yeah.
The actual process of creating credit is literally just a ledger entry.
Yes.
That both the asset and the liability are created simultaneously. The purpose of reserves in the banking system, the reserves that they hold at the central bank, are for settling accounts between the various members of the banking industry, the banking sector, at the close of each business day. So they'll
Yeah.
net off their. So if you've just got a loan from the bank.
Yeah, I know that.
£100,000.
I understand. No, you don't need to explain. I know exactly what you mean.
Yeah.
So yeah, and that's true. The purpose of these reserves is just for the reconciliation between the banks at the end of each day. So is the word fractional reserves, is that perhaps something that made sense before fiat money? So ever since we have fiat money, it doesn't make sense anymore, is what you're saying?
No, it was probably the case when we actually used. Sorry, one moment.
So when we used
Probably
gold
the
money,
case when we had people actually used cash. It might have been a case because, I mean, in theory, the one other use of reserves is if you actually go to an ATM and withdraw some money from the banking system and put it in your pocket. That in theory is coming out of reserves. It's the actual physical cash, but of course it's a tiny, tiny proportion of the overall money supply. Because you're effectively taking the money out of the banking system. Because in all other transactions, especially if you're operating purely electronically, yes, you might withdraw money from Bank A, but however, whether you buy something or that money's going to go straight back into the banking system in the form of your counterparty. Say you go to the shops and buy a bar of chocolate, the money goes into their bank. And what's happening is during the day, nothing's actually changing. When you use your debit card, for instance, it reserves when you tap, you touch and go. It tells your bank to reserve a section of your deposit. It tells the receiving bank that they've got something coming. A transaction has occurred, and they've got an amount of money that's going to be deposited with them, and then that gets settled at the central bank at the end of each business day. Now, that is happening with reserves, but it doesn't. That is not what is being. That is not your deposits, and it's not what the your counterpart. Whoever's shop you've gone to.
so there is no
reserve changing hands.
So I understand. I understand what you're saying, and I mean, I'll just explain where I think you're right, but I'm just going to explain how I've got it wrong. It's obviously I've just been using Wikipedia and stuff.
Right.
So, for example, here's Investopedia, and it says there that actually agrees with what you've said, because it says a fraction of their
Yes.
deposits are available for withdrawal.
Yeah.
Fractional reserve bank system where only a fraction of bank deposits are required to be available for withdrawal.
Yeah, that's the bit. I mean, say sorry, go ahead.
Well, I think that's a much better definition, as you've been describing.
Yeah, because say the shop that you bought the chocolate from, they actually bank with your bank. And then literally the bank, everything is netted off internal to the bank, so they will net off your account with the shop's account, but no reserves are changing hands, because
Yeah. Okay. So I think. Okay. I think. I believe actually it was from Wikipedia page, which threw me. But
well,
actually,
it's in a lot of the textbooks. A-level textbooks will tell you the same thing. But in fact,
right.
apparently, the Federal Reserve in America has apparently been going around to colleges and universities telling them not to use this, because basically, I guess what we're trying to say is that the amount of reserves that a bank has does not in any way impact its ability to lend.
Yeah. Okay. So actually, this ties up with my other research. So, you see, one surprise for me when doing this was that the Chinese, if you go back to, okay, so in year 300 BC, they had fractional reserve systems, and even in well, okay, no, because again, according to the textbooks, they didn't, but I think they did. But also the Chinese merchant count houses and the Renaissance Italy. In all these cases, as you see here, so go back to China, they were issuing more notes than they had coins in cases, and so,
Yeah.
and in fact, in Renaissance Italy as well. So that is a fractional reserve system. However, the Wikipedia, or whatever, or well, most of the sources I got say that fractional reserve banking was invented by the Bank of England. But I think actually it was probably before then. But let's just say it was invented by the goldsmiths in London, not the Bank of England. So most textbooks say that. So this makes sense, the term fractional reserve, because it's representative money and you're issuing more banknotes than money you have that you can swap with them. Whereas with the fiat system,
different. I wouldn't necessarily. I mean, fiat is a different concept. I wouldn't necessarily put the two physically
yeah,
together,
I agree.
because you can have
Well,
you could have a fiat system with tokenistic money.
Yeah.
You know, the government says these tokens are worth something.
no, but there's
The
a
fact that
difference.
people are physically.
But we've progressed from a representative money to a fiat money. That's the progression, isn't it?
Yes.
And so what I'm
You
saying
could
is,
have.
well, what I'm saying
You
is
could have a.
So go ahead.
I was going to say you could have a fractional reserve banking system in a fiat money world where people are using physical money tokens that are assigned value because the government says they've got value, but they're not, say, convertible to gold, for instance.
But
because
no, but I think
people are
I
taking
think
money out of the banking system.
yeah,
The key difference today is that the vast majority of transactions never actually leave the overall banking system.
yeah, I understand what you're saying, but okay, but what if tomorrow everyone demanded cash?
That
Yes,
wouldn't
So
be
it is a
it
fractional
wouldn't be
reserve
good.
system, isn't it?
Well, except basically the Bank of England would do what the Bank of England does. It would just pour in as much reserves as the bank required. I mean, this is why liquidity issues can be resolved by banks, by the central bank. What they can't resolve, and indeed this is what happened in 2008, is solvency issues. In other words, when the bank's assets diminished to the point that its trading, its liabilities exceed its assets.
But you've just trying to keep this to simple terms, though. You're saying that a fractional reserve only actually refers to banknotes.
Well, fractional reserve banking is the implication that the money creation process, is a process of leveraging the bank reserve. So, you can lend out 90%, or you can create loans up to 90% of the value of your reserves that then, and that process goes, that's what we taught at A-level, for instance. But that's not actually true.
Yeah.
The only purpose the reserve hold is to provide a mechanism to actually allow somebody
for remittance.
to withdraw money. To withdraw money from, they've had that loan, so they've got a deposit in their account. They then want to try and withdraw that money and spend it.
This is so it's just the only purpose is so that the Bank of England so the Bank of England actually stores all the bank's reserves, and the reserve is just for the bank to swap everyone's numbers around, essentially.
Yeah.
At the end of the day. Well, okay.
Exactly, but because. Oh, okay. So I was just going to say, but because these days nobody, or relatively, unless you go to the ATM and take cash out, which in tiny proportion of things, nothing's actually leaving the banking system. So you move reserves around between different banks. But the actual banking system as a whole is still, net it is exactly the same. Where it gets, how it expands and how lending expands is purely a ledger-based process.
So
as banks create more and more loans, but this is also why when the central banks were almost forcing masses of reserves in the form of quantity, QE and basically buying assets off the banks and giving them reserves. It didn't actually, it somewhat altered the monetary contraction, but it didn't cause any new loans to be created because, one, the wider economy as a whole, people weren't, confident to be wanting to take out loans, and two, the banks, having had their near-death experience, really didn't. I mean, their business is to create loans. I mean, that's how a bank makes its money, by the difference between what it pays for money.
Okay, could you say that we've gone from a fractional reserve system to a no reserve system?
In a way, yes. Yeah, I mean, it was pointed out that the last central bank to require have a true reserve ratio was the Federal Reserve, and it abolished it in about 2020. So yeah, I mean, in that sense, you've got to have capital reserves, in order to ensure that the bank's solvency.
But you accept that there was fractional reserve system before fiat money.
It's not to do with fiat money. Fiat money.
No, before. That's what I'm saying. Before fiat money, when we had the gold standard, was that we have a fractional reserve currency when we had the gold standard?
We probably transitioned from, well, I mean, it depends. It would have ultimately changed at the point in time when the vast majority of transactions ceased to be people physically handing over notes and coins to each other. And when
that happened
now, exactly when
that happened, actually hundreds and hundreds of years ago.
Exactly. I mean, it's difficult exactly when to fix a point.
So I think this is. I think that you probably have even a lot of bankers. Actually, I know 3 bankers actually, who just by chance in my friend group, I have a few banker friends. So I'm going to ask them that question. But I bet you they're just going to instantly go, oh yeah, we have fractional reserve, and then explain what it is, even though they're wrong. Also, I know. No, I'm not saying. So I think you're probably right, but I think what this is one of them cases where, if you go and look into the technical, if you think about it conceptually and look into, if you dug deep into the textbooks, you have the truth, but then 95% of people have a buzzword like fractional reserve banking that they use without really even understanding how the financial system works. I think. So I think that maybe it's been incorrectly used by people, but that's what it means to them.
I tell you what, you wanted to know when did we stop using fractional reserve banking? I think probably, this is just an opinion that sort of popped into my head, but it's probably when we actually got to the point, or when different countries have got to it at different points, concept of a banking system. So the idea that the banks work together through usually a central bank.
Yeah, that's the Bank of England.
Manage it. Yeah, but for instance, you could argue, say in America, it might have come, fractional reserve banking might have been going on a lot longer because it's a much more disaggregated system, partly because of the, and especially historically. I mean, they didn't have.
So if your bank, okay, so if you've got private banks issuing their own banknotes, that's where you have fractional reserve. Whereas if you have, but if you have the moment you have a central bank, that eliminates.
Not necessarily a central bank, but because it's a bit more than that. Although that is probably part of it, but it's, if you think about, say the Wild West, and each town has its own bank that is its own bank.
Yeah.
That finances, lends to the local farmers, and and in theory, indeed, this would have been back in the days of the gold standard. Theoretically, they would, all of that, those bank notes were redeemable in gold. I mean, it's again funny how these things come out. Bank notes, because they're the notes of the bank.
Yeah.
Of the actual bank. I mean, even in the UK, it's only in England until 1926 banks issued their own notes.
Yeah.
Yes.
Now they were redeemable for gold, but and of course, Scotland and Northern Ireland, they still do issue, albeit they're backed these days 1-for-1 with their deposits at the Bank of England.
Okay, well, look,
going back to.
Go on. Sorry, finish, please.
No. Well, no. I sorry. I realise I'm rabbiting on and on and on, so I'll stop.
No. I meant please finish that sentence you were going to say.
Well, I was just going to say, going back to the example of the bank in the one-horse town in the Wild West, it isn't settling with its other bank each evening. It has its customers coming in and out, and it is going to be issuing its notes based on the reserve that it has actually physically in the potentially, or at least in theory, that's what it should be doing. Although if you then look at all the banking crises, look up wildcat banking is one to look up.
I mean,
basically where
yeah. Well, I think I think that you're right. Technically, I think though that most people use it in the term, as you see on Wikipedia, without really realizing how the bank system works. But I think I'm going to have to do a bit of deep digging there. And thanks a lot for your explaining your that's helped me. Thanks very much. And so I'm definitely going to be refining my notes here.
Definitely don't take my word as the final word by any means. But
well, I won't. But I think, you see, a few things hadn't made sense to me either. So, like I say, they've been talking about the apparently, when you had in ancient times there wasn't a fractional reserve. When that doesn't make sense to me. They all talk about the goldsmiths of London being the start of fractional reserve. So I need to, but that perhaps ties in what you've said, because that's perhaps when you had this situation of, no, that's not the case, because you'd have isolated banks throughout history before, even more so. So there's lots of, I think I need to dig deeper to get the terminology definitely correct. And thanks for raising that point. So, okay, so right, so this is actually the start, the history. So, but actually, it's only.
Well, the thing is, to interrupt, the thing is, it is now, 20 to 10, and is it the time to start this? Should we meet again next month? Where are you? What are you up to next month?
So, okay, I know we agreed some dates. I can't remember when the next date is.
I don't think we've got any dates in July.
Okay, I could do one in July if you like. For this, if this
How
is
about the 10th? How's about 10th of July, Tuesday 10th?
okay. I don't want to open my calendar now in case I dox myself, but I'll
Okay.
check and send you a message.
Right, do that.
Now I could do just the ancient banks and then stop there. That's 3 slides.
Okay, why don't you do that? Because
And
it'd be
then
nice to finish by 10.
yeah,
Like,
okay. And then we'll start the history of modern banking. And I'll yeah, and you know, and I think it's going to be good because to do that because I can really look into this and make sure I'm happy in my mind before continuing as well to the modern banking. So okay, so I've got here the history of banking and here the ancient banking, and then here all the technologies which I covered when I did the money stream last month. And the first banking, basically the first writing, was invented by the Babylonians. Sorry, the Assyrians. That's the Sumerians, who preceded the Babylonians in Mesopotamia. But they invented writing, and almost as soon as they'd invented writing, then they invented financial records. And then when later on, when we get to the year 1800 BC, the Sumerians, who had a big empire, um, the Babylonians, when you move on, they basically started using this for banking records. Now, how it started was with barley. So you would have local farmers before the next harvest, they'd borrow barley so they wouldn't starve. And then when the harvest came, they would pay back plus interest.
Yeah.
And so you had barley as the first ever commodity money, and then later on gold and silver as well. And they had all the ins and outs of the banking, really basic banking functions. People using them to store their wealth and usury and lending people money. And the medium of exchange then was commodity money, which would have been barley or later gold and silver by weight, and the unit of account was the shekel. And in terms of the banking ledger, they would use these clay tablets. So we had this initial banking system there with commodity money still. Then if we go forward, the first ever representative money that I could find was the Indian merchants of 300 BC. And so you had this empire called the Maurya Empire. And this was actually analogous to the Roman Empire in a lot of ways, very similar in a lot of ways to the Roman Empire. You can see here 300 BC, in red there, the Roman Empire. If I make that bigger. But that was when it was still like a republic. That was before it was the proper Roman Empire. So you had the Mauryan here in brown.
Yep.
And it was a massive empire. And interestingly, when you look at what was going on the rest of the world, everyone was still peasant, well, sort of cavemen and stuff, nomadic. Thanks. And and so that's quite fascinating that there was this empire in India at this time. But of course, as the first ever massive empire, apart from Babylonians, the before them and a few others, they had a massive trading network, and so plus they had writing, and they'd started using palm leaves to keep records. So they had these silver coins, which are quite dashing silver coinage that they used as their currency. But they started these tradesmen to transfer wealth between locations when they did trading deals without the danger of money. They started using bills of exchange, and so this is a first instance of representative money. And so they had their commodity money, which was silver coins, representative money, which was they used to call them Edesha bills, and they had ledgers, which I think was palm leaves. It was not easy to get good detail on that, and their unit of account was silver. But that was obviously only limited to within that empire. There wasn't any world kind of obviously currencies or anything. Okay, so that's the Indian merchants. Okay, the next thing is the Chinese merchants at the year 1000. So actually, if you go back as far as 600 AD, there were these proto banks actually in China, and in China they used to use these copper coins in the Song dynasty, and basically these same copper coinage. So yeah, so instead of using copper or gold, because they didn't have any copper or gold in sufficient quantity, they used because they didn't have any gold or silver, they used copper and copper coinage. And they used to, reason why they've got holes in them is because they used to loop them together in strings. And these are actually called cash. So the unit of account was cash. And that's obviously where we get the word cash from. And so anyway, these traders, when the Song dynasty had become a big empire, they were using these counting houses, which were like proto banks. And they started issuing what were called Giozi, which were here you see one, the first ever paper banknote from the year 1000. And that's so when we have the first representative money. And actually, what happened was, and you got here in this diagram all the basic functions of a bank. But what happened was, as soon as they started issuing these notes, then you started having some of the banks a bit of corruption, and actually they used to get local merchants. They used to give monopolies to local merchant houses, so only certain merchant houses were allowed to print the notes. But then, of course, obviously, people, some of them started at the mid of night. They would print off another couple of thousand for themselves, and you got all kinds of corruption creeping in. And then, as soon as so you actually did have fiat money here, even back in 1000 AD. But whenever you had fiat money, it would immediately lead to hyperinflation and then collapse of the economy. And then people would revert back to using silver bars and things. And actually, there were some cases where in the Mongol invasions, the local people were banned from using anything other than the paper notes after hyperinflation. And then they basically would prefer to use barter, in fact, reverting back to barter, than using these fiat notes. So this is really interesting that you actually had fiat money as soon as paper was invented. Paper banknotes were invented. You had fiat, but it failed. The system couldn't support it. and we got 15 minutes before the next bit will be the modern banking. So just there, does perhaps PHS has, or maybe Keith, why do you think the
Yeah.
fiat money wouldn't work in China, but it works now?
Well, okay. So I studied this for when I did my master's in finance, actually. So they when China invented paper money, the initial expansion of the money supply created a great financial boom. But there was obviously a rule by an empire then, and there was no check on the emperor, the monetary authority, just printing more money. So they did, and so they're actually they went bust. You had 3 hyperinflationary busts basically, and in the last one, it was just paper money just became totally discredited for generations. Essentially, because there's no check on the power of the emperor, and he can just, any problems he has, he just prints a bit more money, and that gets completely out of control. So, I mean, the thing about independent central banks is that they're independent, they have a mandate set by the government, and they don't benefit directly from printing more money. And so because there's they have to declare what they're doing all the time, you can see how much money they're creating, and they have a mandate set by the government to stop them printing money. The reason we went back to the gold standard is that you needed a check on money printing. And the system we've got now with inflation targeting essentially puts a legal limit on the amount of money that can get printed.
Right.
So in answer to your question, there was no check on power. They could print whatever they liked.
Right. There. So the tech. It's only because of new technology, essentially, and innovation, you could say that it works.
Well, no, it's more a limit to the power of the printing authority. Under the Chinese emperor,
Yeah.
he was ultimately responsible for how much money he got printed. And whenever he got into any difficulty, rather than raise taxes, he'd print some more money.
Right.
Whereas now we have an independent central bank whose mandate is to limit inflation, which limits, how much money is created by the system.
Yes. So
although
go ahead, PHS.
I was just going to say, although you could argue that, I mean, the real limit is the self-control or otherwise of governments, because ultimately an independent central bank is only as independent as the government decides it's going to be.
Yes, that's very true.
And one topic we haven't covered here, and we won't go into any details, but of course the other, apart from credit creation, the other source of monetary expansion is of course government spending. And you only have to look at Argentina to see effectively doing what, as you said, the Chinese emperor did. Whenever he needed some money, he created some more wealth. That's exactly what Argentina's been doing up until Milei took over. And there's examples of it throughout history.
But what's
PHS makes a very good point there, in that nominally the Argentinian central bank is independent, but then they appoint the central bank governor who does what the government wants, and then they manipulate the inflation statistics to tell them to give you whatever answer you like. If you have because the central bank responds to is responsible for the government. If the government decides to corrupt the central bank, there's not much you can do about it. But the effects are very bad, as you
Yeah.
can see from the Argentinian
So
economy.
self-interest. So I mean, the way I'd say it is now
Yeah.
you have self-interest of different sovereign states, and also relatively good rule of law and accountability of government. Whereas
Yeah.
where
Yeah.
you have these, you know, in the year 1000 AD, you know, there just wasn't that level of control or accountability possible.
Accountability.
I mean, I think
Yeah.
maybe also the fact that you have all these different currencies in competition now, whereas then it would only be that region that would use that currency in isolation. Actually, the same with Argentina. The Argentinian peso, no one else has no interaction really with any other currency. So, or no one else buys it anyway. So, you know, maybe also when you've got an isolated currency, you're you're just going to go bust. Whereas if you've got a currency that's linked, then there's an incentive of self-interest
Well,
there to not debase your currency versus the others.
yeah, I mean, well, it's exactly that. I mean, what will happen is if you have an alternative and one currency is being debased, then people will switch over to the currency or the unit, you know, the unit of transaction that is retaining its value,
Now, there's
Yeah.
providing it's liquid enough to actually transact in. That's the other key to it. You've got to have enough of it to actually be a useful money supply. But if there is,
now.
then
I
that's
mean,
what will
for me,
happen.
there are of course some people that say all fiat currencies in history have ended up in bankruptcy, but the way I'd say it is that it's fascinating that in the past, as long as back as year 1000, there were fiat currencies, something I never realized before, but that the the technology and the stability of government or the isolation of government is why it failed instantly then. But whereas now we have got a system where it can go on at least for as long as
But
recorded record.
Yeah.
the other point to note is that all to some extent all currency is fiat currency, even where you do have a gold standard. Or
Yeah.
it's certainly any representative, because the fact is people, even when the gold standard was the thing, people didn't transact in gold. People didn't carry around gold sovereigns. You know, the government occasionally did between, you know, if they're paying their armies or paying each other. But vast majority, even in the 19th and 18th century, was representative notes that were theoretically redeemable for gold. But of course, you know, how redeemable they were in reality
Yeah. Now the thing is
was
that's what I
yeah,
put down to being fractional reserve though, because you'd have way
yeah,
more notes printed than coins to
yep,
redeem them. Is perhaps that definition there.
yep.
Um,
Mm.
but whereas fiat is definitely where none of them are. But but I think yeah, I think definitely a lot of the terms that get bounded around on TV even and stuff are the reality is actually a lot more complex than these
Yeah.
terms that people bound around. Even the word fiat and even the word fractional reserve. There's actually a lot more nuance obviously in there than. What's your feeling on what we were discussing? Because before we go, Keith, because I'm going to do quite a bit of follow up on this actually. So, what's your take though on this? What me and PHS were talking about with fractional reserve. So with this slide, even,
Yeah.
how would you slice that?
Well, I think PHS's definition is a pretty good one, frankly. I think that, he's right that when a bank creates a loan, it simply credits the money to the loan ease account out of thin air. And the bank reserves are what are required to meet its day-to-day liquidity needs.
Yeah.
And those are mandated by the regulator. But if it gets into trouble, it simply loans as it goes to the central bank with its loan portfolio and converts some of that into cash. So it's a question of when banks get into trouble, it's when their loan portfolio is of poor quality, they've lost a lot of money, and they don't have enough good quality assets to meet their liabilities.
Yeah, and I think.
Yeah. Although in
Go
on,
you go ahead. Sorry.
I was going to say, even then, I mean, central banks, as we just saw with, during the whole SVB crisis, central bank will loan money at par, even on assets which are potentially impaired.
Yeah.
In order,
that's very true. That's very true, and is Beige would not be very keen on that, frankly.
But,
You lend at punitive rates. You lend at punitive rates in infinite size against good quality assets, but they didn't lend at punitive rates, and they didn't impose enough of a haircut on assets. So the banking system is essentially being subsidized by the taxpayer, as far as I can see.
Well, it was being. I suppose the argument the Fed would have said is, well, these are treasuries. They will ultimately, be paid out at par at some point, though.
Yeah.
But yeah, I mean that you could potentially see central banks doing more egregious forms of that.
That's true, but I mean the thing is, if you want to, depends what you want to achieve. If you want the banks to be more prudent, you have to change their behavior by making them pay more for their reserves. And what the Fed did essentially was provide them with all the cash they need at subsidized rates. So, well,
I guess. Well, they weren't subsidised though. They were slightly above the par. The going bank rate. So there was a slightly punitive, but not much.
That is true, but not much. But much better than they receive in the market is my point.
Yeah. Well, absolutely. But I guess it's the difference between liquidity and solvency, and the central bank can get the whole system out of a liquidity problem by simply creating as many bank reserves as are required and simply taking on. But it can't alter the value of the assets, the bank's assets. And if a bank's assets, whether that be loans on mortgages or business loans that have failed, etc., if the bank's assets are fundamentally impaired, then the bank is insolvent. And that ultimately destroys its ability to keep on lending, which is itself how the bank makes its money, because of course it makes money by borrowing cheap long term and short term and lending at higher rates, but you can't do that if you're insolvent. Not least because nobody will have any confidence in you as an institution. So nobody will provide you the capital to fund those loans that you make. Therefore, you're basically bust. And once confidence is lost, even when you're not insolvent, like Credit Suisse, once confidence was shot, that's it. As a bank, you're gone.
You're dead. Yeah. People start withdrawing the money. That's it.
Yep.
You're done.
Exactly.
Great. Should we call it quits there?
Yeah.
Because it's just past 10 o'clock.
Okay.
And we'll do the next part in July. We will sort out a date.
Okay.
Thanks very much, Rogue, for doing all the hard work, and PHS for your contributions tonight. It's been fun.
It has. And
Thank you.
it's so look forward to seeing you in the next one, everyone. Thanks. Bye. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.